Okay, so my name is Keith Miller from the Upslope Group, fifth generation Montanan, and so we're here to talk a little bit about 401ks and IRAs and how to use those to invest in real estate projects. To introduce myself, I got my start in real estate 12 years ago. First started on backyard infill projects. I've graduated, gotten larger and larger, and now I have a project up in Great Falls that we'll talk about later. I'll hand it over to Paul to introduce himself now.
Well, thank you very much, Keith. Really appreciate the opportunity here today. Yeah, very thankful to both you, Ryan, and Upslope Group for the opportunity. I belong to Equity Institutional Services, a premier division of Equity Trust Company, and I'm very, very excited to go ahead and speak today about self-directed IRAs and how people can go ahead, use these tax advantage dollars and place them into real estate investments rather than having them sit into different mutual funds, exchange traded funds, and the like, rather going ahead, helping them get into those real hard assets.
Yeah. So Paul, so who would you say this webinar is for?
Yeah, I think this webinar is really going to be for those who have, first and foremost, former 401ks with former employers. That's going to be a huge advantage to go ahead and really tap into those funds through what's known as a direct rollover to where you could use those now to invest into real estate. But for others as well, with IRAs, a very common type of retirement account for US investors, those with other types of accounts, such as 457Bs, as well as thrift savings plans, those uniform guard members, those who are employed at the local level, the state level, as well as teachers. So many different types of retirement accounts out there, even things such as education savings accounts and health savings accounts that can actually be used to start self-directing and to start diversifying your portfolio into real estate. So really any of these Americans who have these types of accounts or those retirement funds, even such things as a qualified annuity, would be eligible to go ahead and do a direct rollover and get placed.
Very cool. Yeah. And so why would you say this is like a useful topic for investors?
Yeah. It's a very useful topic in terms of allowing them another pool of liquidity to go ahead and get into a deal. Here's a way that they can tap into former 401ks that typically are abandoned, Keith. I mean, a lot of Americans have three or more 401k accounts that are sitting invested into an offering they know nothing about. Um, and they may be generating returns, they may not. Uh, a lot of these investors won't even check into that account to see how it's doing because they've forgotten about it. They don't even know who custodies the investment, where those funds are actually sitting. Now, what we're going to get into today is really going to be the substantial meat and potatoes, the tax advantages associated with it. Not having to pay capital gains tax is a huge one. But what this isn't going to be is this isn't going to be tax or legal advice. We're going to be speaking anecdotally here today. It's not going to be a hard sell. What we're really looking for is just to help educate people, help give them their options. And this is a great way to go ahead and get into real estate with that liquidity, with those tax advantages.
Yeah, that sounds great. So to give listeners sort of overview of what we're going to be doing, so we'll discuss how self-directed accounts work, what's allowed, what's not allowed, and then we'll talk about how this applies to a real project, using, for example, Meadow Village. Okay, so a common situation, as Paul was hitting, is that people have these multiple old accounts, from prior employers, limited control over where the money goes, and there's like one big misconception is that like private real estate and other options just aren't available for accounts like this. And the truth is like, the IRS does allow ways to invest in these alternative investments when structured correctly. And that's where we'll be talking about self-directed accounts. And so, Paul, can you explain to us like what a self-directed IRA or 401k actually is and get into some of the specifics?
Would love to, Keith. So at the end of the day, a self-directed IRA is going to be an IRA like any other. What's really going to matter is who's the custodian, who's the driving hand behind it, and can they make it feasible for you? It's going to have the same exact rules, same exact stipulations as any other IRA account would. The self-directed portion is one big marketing term that's used in our industry. Really, what that annotates is who is the custodian holding those funds? Who's the banker in that? Who has those assets under custody? And are they able to get me into an investment I want to actually participate in? Now we just had the Super Bowl here a week ago. A lot of different financial advertisements were on there, right? A lot of notable groups. You could walk down the block of any main street and find a financial advisor to work with. Now those groups are very concerned with assets under management. That's their number one driving revenue factor, and it's really what they're honed in on. Due to that, they're concerned with going ahead, getting you into those proprietary funds, the S&P 500, any of their proprietary offerings. We're here at Equity Trust. We're concerned with the assets under custody. We want to hold it on paper and be the bank, actually hold custody to it. We'll get into this later, but that investment is going to be through the IRA. And that's where we see our revenue through a flat fixed fee schedule at. We're looking to serve the market and really go ahead and serve a specific niche of that market. And really that's where we built our entity the past 52 years.
Got it. And so like, what changes between like a standard IRA and a self-directed IRA?
Yeah. So the biggest change between the two is who's in the driver's seat, who's that custodian, and can they administratively hold custody to it, and do they want to hold custody to it? So that's really what one of the primary differences is going to be our client service department. It's going to be that we can actually hold asset to these items, hold custody, so that we can get it placed. Where let's use an example of Fidelity, for instance, right? I mean, they're not going to go ahead and they will not get you into those real estate offerings. It doesn't fit their business model and what they're trying to achieve.
Yeah, that makes sense. Yeah. So would you say like, as a general rule, active 401ks typically aren't the right fit for something like this?
More times than not, Keith, I would completely agree with you. I'd say out of every 10 times, 9 investors are told they're not allowed to roll over those funds with an active employer. But I'd say out of those 10 times, 1 investor is allowed to. Now, this is going to be known as an in-service rollover. That's what we're going to refer to the movement of funds out of that active employer 401k and into that self-directed IRA. It's going to move from one financial institution to the other. But when it's with that active employer, that plan provider has the ultimate say on whether or not you can go ahead and do that direct rollover. Now, there are typically some instances where groups will allow for it. I've seen exceptions made for those over 59 and a half, and for those who have reached a certain number of years of tenure with the organization as well. So those are things to look out for. And it's always worth at least asking the question, can I do an in-service rollover to your plan administrator? Well, worst case scenario is they're going to tell you no. You're in the exact same position that you were in yesterday.
Right. That's what HR is for, right?
That's exactly right. They're there to help answer your questions, help assist you, and find you that answer.
Got it. And so like, am I correct in assuming that like you focus, as a company more on like administration, not like giving specific advice on specific investments?
You're exactly correct, Keith. That's really our role as a custodian, is to go ahead and help you get from point A to point B and get you the right vehicle to do so. We're not actively performing due diligence on deals, and we're not endorsing investments. In fact, we're not allowed to. So our role is not to play matchmaker, but rather to go ahead and help serve that limited partner and get them into that deal as quickly as possible with convenience, as easy as possible.
It makes total sense. Yeah. So when you do have, the solo 401k or the a old account with an old employer, like what are the things you can invest with the self-directed account?
Yeah, so many options, Keith, when it comes to the alternative asset community. One of the most popular by far is going to be a real estate syndication or just investing directly into real estate. And that's what the majority of our clients are going to do, is go ahead, make a syndication investment, make a real estate purchase, or make a private equity investment, right? Maybe not necessarily directly tied to real estate, but maybe to a group that's pre an initial public offering as well. We'll also work with venture capital groups as well, with angel investors looking to go ahead, deploy their retirement funds. We'll work with those who want to go ahead and trade futures. So they'll trade the spot price of things like corn, soy, so many different things you can trade in the commodities world. But that's a huge segment. We'll serve foreign exchange So foreign exchange trading is another popular one. Precious metals, gold and silver, secured notes. So going ahead, becoming the bank, loading out your retirement funds to a third party would also be allowed for as well. Um, there's a very, very wide blue ocean of these investment opportunities that you could go ahead and use with the IRA. But I want to specifically really call out those you can't make, because that's going to help delineate this a lot more. So when it comes to a self-directed IRA, investments that you would not want to make, you would not want to purchase an insurance policy, invest in S corporation stock due to its already previous tax advantages, or anything that's an antique or collectible, right? Anything that the IRS can't put a fair market valuation on, you would not want to go ahead and invest in. Because when you look to take that distribution, there's not going to be anyone here on this earth who can actually tell you what it's worth, right? These are items where the beauty is in the eye of the holder. So maybe it's a hot rod from the 1960s, for instance, right? Antiques, collectibles like that, you'll want to go ahead and avoid. And then anything currently federally illegal. So any cannabis touching business at this time, you would want to go ahead, avoid investing in with your retirement funds until it were to become legal federally.
That makes sense. Yeah. And so it's like when I guess it's going to depend on whether it's like a Roth IRA or a 401k. Can you talk a little bit about like tax deferred or tax free growth and how
Yeah,
that's going to vary depending on the investment type?
would love to. So what I really want to hit on is pre-tax versus post-tax status,
Okay,
because that's going
great.
to be huge. That's going to be huge. Now, what vehicles are going to fall in that pre-tax? That's going to be your traditional IRA, your SEP IRA, your simple IRA. Now these are going to be pre-tax in nature. So when you go ahead and contribute to the account, you're actually able to take a tax deduction depending on what your earnings are that year. So you may even actually see a kickback when you're contributing to it.
Mhm.
Other investors who earn more, they're not going to see that same kickback. But when you go ahead and place funds into the account, you're not taxed at that point in time. Now, let's fast forward till 59 and a half. That's going to be the golden number. That's going to be the age of distribution. So starting at 59 and a half, you're able to start pulling monies out of the retirement account and into your personal account. But if you do so with any of those pre-tax accounts, it's going to create a taxable event, and it's going to be taxed at the ordinary income rate. So it is very important once when you turn 59 and a half, and when you want to start tapping into that capital for whatever reason, whether it's to buy a new Chevy Silverado, take the kids to Disneyland, what have you. It's very important when you take those distributions to understand that it is going to be added on top of your earned income. For instance, let's say I'm 59 and a half this year. Let's say hypothetically, I made $100,000 this year and I took a $20,000 distribution. Well, now my ordinary income tax for the year is going to be at that $120,000 level, that threshold. Really important to get with the CPA at this time. And I would make sure to write that down for those listening. Once when you start taking distributions, it's time to get with an accountant, because you want to ensure when you take those distributions that it's not going to bump you up into a higher tax run, where now all of a sudden I'm not only paying an additional percentage of taxes on my distribution, but of all my income for the year. That's ordinary. So something
Mhm.
to be aware of once when you're starting to dwindle that account. Now, starting at age 73, Uncle Sam's going to tap you on the shoulder with those pre-tax accounts, and he's going to say, "Hey, I'm going to need some tax revenue right now." And those are going to be required minimum distributions when you're going to be forced to start taking some money out of that account on an annual basis. Now, we compare that to the Roth IRA in that the Roth IRA is going to be completely post-tax, which is an amazing thing. You're able to compound wealth in the absence of taxation in these accounts. Now, you're going to be paying the taxes on the contribution that you're putting into the account. So you're still going to get taxed on those dollars immediately, as compared with the traditional, you're paying it later in life. But the benefit of going ahead and contributing to that Roth is that compounding interest, once when you pull it out post 59 and a half, is not taxed at all. So if you're working with that Roth IRA, not as important to have the CPA in your corner at that point in time, because when you're taking those distributions, it's all cash. Very, very tax advantaged account. We'll see it used for many different private equity investments due to the higher levels of return, right? And due to those levels of return, a lot of investors are more incentivized to use their Roth IRA for those private equity investments because they're not going to be paying the capital gains taxes on those returns once when they take those distributions.
Yeah, that makes sense.
Now, while we're on this topic, I I did have something come to mind, and that's known as a Roth conversion, right?
Mhm.
So going ahead, converting the pre-tax into the post-tax position and intentionally creating a taxable event. Many people are familiar with the Roth conversion, going ahead, moving it from one bucket to the other, paying the taxes on said amount to push it over into a post-tax position. But what I want to talk about is called a discounted Roth conversion. Let's say you do this in kind rather than with dollars. So using a hypothetical, let's say I make an investment of $100,000 into a syndication with my traditional IRA. Year one passes. Let's say the valuation of the fair market actually goes down. Let's say it falls to 80,000. Well, at this point, I can now assess the real estate deal. If I still have belief in the deal and that it's going to increase over time and rebound in value, I can now go ahead, create a taxable event, do what's known as that discounted Roth conversion, pay the applicable ordinary income tax on the 80,000, knowing that one day it's going to jump back up to 120,000. And now
Mhm.
I've only paid the ordinary income taxes on $80,000 of said real estate, in which it was currently
Oh,
valued with at that time, with the
yeah.
full understanding that real estate's a long game and my investment's going to be there for 3 to 7 years, full well knowing that it's going to pick back up and spike in the future. And now it's spiking in a Roth position that's post-tax in nature, which is a very, very
Interesting.
attractive thing.
Yeah. Huh. I didn't realize that was an option. That's really cool.
Yeah. So it doesn't need just to be dollar bills that you're converting. You can actually convert an asset in kind as well.
Huh. I'm gonna figure out how to get that lowered valuation that in the next year or two. Yeah. Cool. Well, let's keep marching forward. So I'm going to give
Yeah.
a quick high level overview of like what it would look like to invest in a project like Meadow Village, which is the project that's we're raising capital for now. So the timeline of this is roughly 5 years, and so to take a step back, I guess it's a 163 home subdivision in Great Falls, Montana, and so the whole vision is to use factory built homes to lower our build costs to drive higher margins. And so it's like you can remove risk by using factory built homes by taking roughly 10 subcontractors out of the process. You lower your material waste and you lower your risk of on-site both cost and time overruns, which is really great. And so you're just removing a lot of construction risk, which gets us really excited. We're looking at strong demand. We've got a third party market report that's looking really good. And we're individually selling these 163 homes. And so what this would look like from an investor perspective is, at the beginning of the project, let's say you invest $100,000. What that looks like over time is that, the investment is put, the 100,000 is put into to buy the land and start building the first homes, and then that money is recycled. Any profit is recycled back into the project because we need to be able to pay for phase two and then eventually phase three. Towards the end of that 5 year timeline is when we start returning capital back to our investors. And we're projecting a 22.4% IRR and an equity multiple of 2.77. So for every $100,000, we're projecting we return 277 grand after those 5 years. And so, for example, that like discounted Roth could, even if you didn't even get a discount, it's like you could still, even if you're just, trading at 100 for 100, that could still really help you out on the tax side. So that's interesting to think about. Yeah. And so I was talking with an investor just yesterday, referred him to Paul actually, who was saying like, oh, this is actually a good fit for my retirement capital because, with the long 5 year timeline, like that aligns with my retirement goals. He's on the younger side. He's like, I don't need this money for, lot more than 5 years to be frank. And so I think that could be it's just another tool in the tool belt if you're thinking about how to get involved in a project like this. And so um and just to touch on, and obviously, like I have some bias. I want to be clear about that. But like I was just looking at like the Schiller PE ratio is what I like to look at, the price to earnings ratio of the entire stock market. It's like for every dollar of value, what are the earnings? And the long-term average is like $1 of value earns $16 of earnings. And so right now, the current average last time I looked was for $1 of value, you have $40 of your yearly earnings. And so it's like the market has only been this arguably overvalued one other time in history, and that was at the peak of the 1999 tech bubble. So it's like fundamentally, I just don't see how returns are going to be that great in, in an index fund or a specific stock over the next 5 to 10 years. And so I'm not saying, oh, put all your money into real estate because I think that's not a good idea either. But I think this is a good time to diversify, in my opinion, at least. Yeah.
And I'd follow up with agreeance there, Keith. I mean, you even see individuals like Michael Burry now taking out $1 billion to short AI stock. It's no, and he went ahead and has obviously done it in the past. If you've seen the movie The Big Short, I mean, it's a incredible film. But yeah, you're not the only one with those beliefs, Keith.
Yeah. And so just check my understanding here. But for my understanding, like your IRA is the vehicle that passively invests in the syndication, and then the cash flow and the return of capital goes back into the IRA. Is that correct?
That's exactly right. That's
Okay.
exactly right. And the reason it is, Keith, is because the IRA is the one making the investment. It's not
Right.
it's not Paul Herbis making the investment. It's Equity Trust Company as custodian for benefit of Paul Herbis, account number 12345. So you're spot on, Keith, and that all returns are going to be funneled right back in the IRA.
Got it. No, that makes sense. Okay. So what does the setup of one of these accounts look like? And like, what does the timeline on that look like?
Yeah, so the timeline is going to differ depending on how the account's being funded. So if it's coming from anything other than an IRA, we're going to do what's known as a direct rollover. Typically takes around 2.5 to 3 weeks. It's going to be on the longer time horizon, for sure, of the movement of funds. And here's why. Once when we establish that like kind account, ensuring that it is the same tax status as the funds we're doing that direct rollover from, that current custodian will actually cut a check and put it in the mail to us. After we receive said check, we're actually going to hold on to it for 5 business days to ensure the check clears. At that point, we're going to go ahead, reach out to the investor, have them endorse subscription agreement, and give us a verbal authorization as a security feature. Then we would go ahead, post the wire in 24 hours. Most of that timeline is 1, waiting for us to receive the check, and 2, our hold on said check. So that's why the rollover timeline is typically going to be longer. As compared to an IRA to IRA, trustee to trustee transfer, it's going to be done via wire. So a lot quicker, typically on the 1.5 to 2 week horizon for those IRA to IRA transfers, depending on who your custodian is. Some move very quickly, some are a little slower to move. Now, really where it would start is having a goals-based conversation with myself. So meeting via call, Teams, what have you. And I would directly assist in going ahead, ensuring we're opening up the right tax status account. And then I would go ahead and assist with the transfer or rollover of funds. With the rollover, funds are being pushed to us. With the transfer, we're requesting funds from the current custodian. So depending on who your custodian is with the transfer, they may or may not allow for electronic endorsement. I would be the one to go ahead, help assist through the process, get that endorsed transfer form, and get those funds over here.
Got it. And like, what are some of the things that usually delay the timeline? Because I'm sure that can be common.
Yeah, it's crazy, but a lot of banks like holding on to funds and taking a while to get them moved. And that's typically going to be associated with interest. So these are large institutions, right? Working with the Fidelities, the Schwab, the JP Morgans of the world. They have lots of processing orders. They have lots of requests on any given day. So a lot of these banking titans are slow to move, right? So a lot of it is us waiting for paper to be pushed back to us. Would truly avoid waiting until the last minute to go ahead and get these set up due to the length of time that's associated with the movement of some of these funds. Definitely something that you at least want to have the conversation early on to see if it's going to be a good fit before getting into that.
No, that makes sense. Yeah. So like what sort of like rules or guardrails are there for like these kind of investments?
Yeah. So there are rules that apply that the IRS comes down and says, hey, you need to abide by these. and the first that I really want to speak to are disqualified parties. So these are parties that the IRS calls out right away. Hey, you're not able to transact with these. They're too closely held. They're not at arm's length. And that's going to include oneself. So self-dealing is going to be an area where you could get into trouble, right? And that would be if you were to go ahead and sell any assets you personally own and purchase them with your IRA. For
Yeah.
instance, let's say I own two acres of real estate. I want to sell that to my IRA. I can't do it. I'm prohibited to my IRA. Wouldn't be able to do that. The IRS is going to view it as an early distribution and as you looking to avoid and go around those rules. Other members that it applies to, your spouse as well. Go figure, especially when so many spouses have joint bank accounts. Um, other family members that applies to, direct ancestors. So my parents, my grandparents, any of my direct descendants, so my kids as well, any of their marriages, so my son and daughter-in-laws, and then any of their offspring, so grandkids, great-grandchildren, down my lineage. Those are the
Got it.
parties we're not going to be transacting with these retirements.
Second cousins are okay though?
Second cousins are okay. First cousins are okay.
Oh,
Bro-
okay.
brothers and sisters are okay. Uncles and
Oh,
uncles and aunts are okay. Nieces and nephews are okay.
okay.
The IRS doesn't think they're going to do you a favor, Keith. At the end of the day, they're not going to cut you a deal. They're not your parent. They're not your son or daughter. There's not that direct relation and responsibility.
Got it. Makes sense. And so like when it comes to handling of the cash, what are the rules with
Yes.
that?
Yeah. So it's a lot easier if you make the investment directly through the IRA. So if you're investing into a syndicated deal, it's way harder to commingle funds. It basically can't happen, more or
Mm,
less. But if you move into the world of the checkbook IRA, which is an IRA that owns a manager managed LLC whose sole member is the IRA. Now, this product's specifically going to be used to purchase real estate outright more times than not. But this is where I see the commingling go awry because now you have access to a bank account of said LLC where all your retirement funds are sitting, where you can freely go ahead, write checks to a syndication if you'd like, purchase real estate property if you'd like, do all of the above, invest as you see fit, but you're not able to write yourself checks out of that account, right? You're not able to pay yourself for a fee for going ahead, being a manager of it, anything of the sort. You can't go ahead and use it to fill up your truck, buy a cheeseburger for your kids at McDonald's, what have you, right? Those need to be used purely for investing and the expenses of that investment.
that makes sense. You don't want to fritter those retirement funds away.
That's right. Because at the end of the day, you still need the custodian to make the contribution and distribution. Even with that checkbook IRA model, you still need to send a wire back to us so that we could go ahead report to the IRS correctly. And the same of putting funds into the IRA account, you're still going to use the self-directed IRA as a vehicle to push things to and from the LLC that's making those investments.
Got it. Makes sense. Yeah. And so like how do you make sure you're avoiding any penalties? Because that seems like the worst case scenario.
Yeah. By far, ensuring we're not dealing with any of those disqualified parties, right? Because if we are, what it could lead to is a forced distribution, which
Mm,
is where your IRA account now becomes personal cash overnight. Your entire IRA account that this investment was made out of is now going to be depleted, pushed into you as ordinary income you've made this year, and now we're creating a huge taxable event.
yeah.
And if you're not 59 and a half yet, well, there's an additional 10% penalty on all of that as well. Um,
Yeah.
so something you want to avoid at all costs, surely.
Yeah. Makes sense. You got to protect that. That's the tax advantage status.
That's right. That's exactly right. So playing by the rules is an important part. Having a goals-based conversation, I think, is important too, right? Having that on the front end can save a lot of heartache on the back end. That's for sure.
Got it. Cool. So what questions were submitted or the pre-submitted questions to make sure we're addressing
Yeah.
yeah.
Let me go ahead and grab those right now. Perfect. I have them here. So one of the more common ones that we see here um, on a very frequent basis or is going to be applied to funding rules, right? Like what are some certain funding rules that apply when you're looking to go ahead and make these investments? Like what should be taken into effect? And with those funding rules, there's going to be a stark difference in between those accounts too, right? Whether we're looking at an IRA or even a solo 401k, two completely distinct products that I want to speak to.
Hmm.
The solo 401k is going to have a much higher contribution limit. It's going to be one of the stark differences compared to the IRA. And you're able to contribute in that solo 401k in a Roth position, where historically you're only able to push a couple $1,000s into that Roth account every year. Um, Now you could go ahead, contribute up to $70,000 annually into a post-tax status through what's known as that solo 401k. Now, the solo 401k is going to have stricter requirements in terms of who qualify. You need to be a business owner, and you cannot have any employees outside of a spouse. So no common law employees. And then you need to have earned income. But if you check all those boxes and you're really looking to go ahead and start funneling funds into a tax advantaged position where you can create wealth in the absence of taxation, that Roth solo 401k is what you're looking for. So something I wanted to make sure to highlight tonight.
No, that's good. That's a good point. Yeah. Other questions?
Yeah, in regards to other questions that I'll typically see from investors is how can I go ahead and ensure I'm selecting the right custodian, right? How am I sure that I'm working with the right group? There's so many IRA custodians out there. Who should I work with, right? And what factors should these investors consider when going ahead and taking a look at these different entities? And the first thing I would go ahead and ask them is, what does that client service department looks like, right? Because at the end of the day, there's always going to be somebody to help you on the front end, right? There's always going to be somebody to help you open the account and somebody to take your money, right? But who's going to be there on the back end when it actually matters? When you have a question on a required minimum distribution, when you need help making an additional transfer into another investment opportunity that you now want to make out of that self-directed IRA. And that's, I think, is going to be a stark difference between our entity here at Equity Institutional Services and others in the marketplace, is our ability to go ahead and ensure that our clients have a dedicated client service representative, that they're not needing to call into a 1-800 number, pressing 1F, pressing 2F, pressing 3F, that they have a heartbeat on the other side of the line, I think is pretty important.
Yeah, totally. Other questions?
Yeah, key tax advantages. The biggest one is going to be the avoidance of capital gains tax. At the end of the day, it's going to be a huge reason for going ahead using a self-directed IRA to invest, is that I'm not paying capital gains taxes on my returns. Huge benefit of going ahead and earmarking that IRA. Other common mistakes that can be made with that IRA. I also want to speak to a few more of those. So we touched on disqualified parties. Another one that I want to speak to is personal credit. So, and this applies to purchasing real estate property more often than not. But when I'm looking to go ahead and invest as a real estate investor, I'm not able to use my personal credit on behalf of my IRA's investment. So when I go ahead and I'm looking to close on a single family home, I'm not able to go to my local regional bank and go ahead and get traditional financing for that investment, because I can't use my personal credit for my IRA's investment, because it's not me making the deal, it's my IRA. And I'm a prohibited party to my IRA. So the option there would be a non-recourse loan. You're going to be going ahead, putting at least a 30% commonly down payment down with the IRA account, and then secure the loan against said property. So if I were to ever default, what have you, not make that payment on my IRA, then the lender would go ahead, seize the property as collateral at that point. But it's important because now I'm not having to personally guarantee the loan.
Yeah, no, that makes sense. That brings up a question of mine, actually. So how does accreditation work then? Because, we have a 506c, so we require accreditation for our investors. Can you speak to that?
Yeah, so it passes on. So if an investor is accredited, so is their IRA. So it's a pass-through
just
status.
making sure.
Yep. So we're all set there. As long as they meet that accreditation status, so does their IRA account.
So the accreditation does pass through the sort of IRA manual or whatever you want to call it.
It does.
Okay, just making sure.
Yep.
Cool. So I think that hits the main points. So we can start to wrap up. So for anybody interested in Meadow Village, I'm happy to have a follow-up call. I can go through materials or any of your questions that you have. For any investors thinking about using their retirement funds of various kinds, I can share Paul's contact information and connect you with him, obviously, and he can evaluate your role or eligibility. So it'll be no pressure situation both for me and Paul. Just we're here to educate and inform, and that's our whole approach. So, if you want to wrap anything up or have any last words, Paul, go for it.
Yeah, just want to thank you, Keith. Want to thank both you and Ryan and the Upslope group for the opportunity today. It's something I'm very passionate about, is going ahead and speaking to IRAs, the tax advantages associated with them. And yeah, here to help when the time is right. Thank you, Keith.
Great. Thanks so much, Paul. Okay. Hope to hear from you soon. Have a great day.